I, Professor B.K. Jain, Dean, Bhyani Institute of Science and Management of Bhyani Group of Colleges, welcomes you in this video lecture series. To begin with, I would make it very clear that I would be giving a series of lectures on the subject Management of Financial Services of MBA 3rd Sem in Finance area. Today's topic for discussion would be item number 1, which is devoted to Indian financial system. In fact, Indian financial system is a broad word, a broad concept which includes financing institutions, financial instruments, their purchase and sale in financial market, rules and regulations, systems and procedures, and regulatory bodies which control the entire financial system and financial structure of our country. To start with, I would divide the entire topic in 5 parts. These are 5 components of Indian financial system. The first component of Indian financial system is financial market. In fact, financial markets can be divided into 2 parts, and these 2 parts are unorganized markets and organized markets. In fact, unorganized markets are those, as the name speaks, on which there is no control of anybody. RBI has no say in these institutions, and these institutions are village money lenders, village traders, indigenous bankers. In fact, no regulatory body have any control on these 2. In Rajasthan, there is an act known as Lenders or Money Lenders Act, but in fact, though this act is there, but the inspectors of Money Lending Act is very limited, and in fact there is no control by these money lending inspectors on the loans advanced by the unorganized agencies such as money lenders and indigenous bankers. Another part of the financial market is the organized. As the word speaks, these are the markets on which there is a full control of regulatory bodies. In organized also there are 2 parts. One is known as money market and another is known as capital market. Money market is a market which deals in short-term lending and short-term loaning or short-term instruments, and in capital market which deals in the long-term instruments beyond 1 year. In short term, the period of a transaction or an instrument is 1 day to 364 days, while in capital market the transactions or the instruments are for a period over 1 year. In money market, we have 5 types of market, and these 5 types of markets are call money market, bill market, treasury bill market, certificate of deposit, and commercial paper. First item is call money market. This is a market. In fact, there is no market like call money, but when bankers needs money, they go to another banking institution and they seek whether they have surplus money or not. A banker goes over phone to another banker and seeks convenience of money available with them, and if they say yes, if a particular banker can borrow money for a period like 2 days, 3 days, 4 days, the interest rate on this call money is also decided on demand and supply and through bargaining over phone, and this way this call money market functions. Another is known as bill market. In fact, in bill market there is a bill of exchange drawn and written between a seller and a buyer. When a buyer does not have ready money, he agrees to the seller that the seller may write a bill on him. He accepts the bill, and in that case the seller goes to bank and gets it discounted from a banker, and through the discounting process it arranges money. Now bills once discounted can also be rediscounted from the country's central bank, that is Reserve Bank of India. Another is known as treasury bill market. Treasury bill market is a market for short-term money. Whenever Government of India is in scarcity of money or government of India needs money, it tells Reserve Bank of India to issue treasury bills. These are promissory notes issued by Reserve Bank of India for a period of 91 days, 162 days, 364 days. These instruments issued by Reserve Bank of India are on behalf of government, and finally at the time of maturity, Government of India provides money to Reserve Bank, and Reserve Bank of India redeem these treasury bills to the purchasers and pay the original amount as well as interest on them. Another market is known as certificate of deposit. These certificate of deposits are also short-term instruments. These are also bearer promissory notes, and these are also issued at discount, and these certificates of deposits are issued by only scheduled commercial banks, and scheduled commercial banks are those whose name has been included in the schedule of RBI Act 1934. The last is commercial paper. These commercial paper are also short-term instruments. These are issued by companies approved by Reserve Bank of India. So this is a very brief about money market. Now I come to capital market. In capital market there are three types of securities. One part of those are known as government securities. Another part is known as industrial securities, and the next part is known as long-term loans. Under government securities, securities are normally issued by central government or state government. These are most liquid securities, but the rate of interest is slightly lower. In case of industrial securities, these are issued by government organizations, government companies, private sector companies, industrial units. Under these industrial security, you might be knowing there are many types of instruments which are issued, that may be in the form of share, that may be in the form of debentures. So these shares and debentures are issued by industrial organizations for collecting money from public. In case of long-term market, there are institutions which provide long-term loan to needy institutions, and these long-term loans are also generally against immovable property, and these loans are also known as mortgage loans because they are for a longer period and are against immovable property. Now you switch over to another component of this Indian financial system, and this component is popularly known as financial intermediaries. These are the institutions which exist between a person who has surplus money and a person who wants money from financing institutions. These financial intermediaries can also be classified into two parts, and the part one is banking intermediaries and part two is non-banking intermediaries. Under banking intermediaries, we have three types of institutions. One is known as country's top central bank, that is Reserve Bank of India. Another category is known as commercial banks, and third category is known as cooperative banks. In fact, Reserve Bank of India also accepts money, but this RBI accepts money from government and government bodies. Individual cannot go and open account and keep its money in RBI. Commercial banks are well-known term, and these are important financial intermediary in the Indian financial system because they collect money from those who have surplus money. They mobilize savings and convert the saving into capital, and this capital is available for big industrial houses for using it for production of goods and services. The third type of banks is known as cooperative banks. These are particularly operating for rural and agriculture financing. These cooperative banks are also can be divided into for short-term period, for a long-term. For short-term, there is a structure consisting of a state cooperative bank, central cooperative bank, and primary societies. And for long-term, there is a separate structure known as cooperative land development banks, and they provide loans for long-term purpose. So banking institutions are a very important financial intermediary. They collect savings from public and convert these savings into investment and provide or fulfill the needs of those who are in need of money. The second part of the financial intermediaries are non-banking financial institutions. Under these non-banking, as the name says, they are not banking institutions. They does not perform any banking function. And under these there are institutions like Life Insurance Corporation of India, General Insurance Corporation of India, Unit Trust of India, and many mutual funds which are operating in the country. Now, I would make it very clear that Life Insurance Corporation of India is one of the biggest financial intermediary. It has huge surplus with it because the insurance policies are taken for a longer period and LIC gets premium regularly till the maturity period expires. Similarly, GIC is another insurance company which provides insurance cover for non-life purpose. It also gets huge surplus and it provides surplus to the needy institutions. Then we have Unit Trust of India, which also accepts surplus of money and makes this money available to industrial units for their use. We have now mutual fund industry. We have lot of mutual funds and they are very popular in last 1 or 2 years, and they accept money from investors. Then they create a trust and they create an asset management company, invest the money in the securities, shares and securities in such companies where return is high, and finally return the interest to the investor. The third category or the third component of Indian financial system is financial instruments, and these financial instruments are also two types. Some are known as money market instruments, some are known as capital market instruments. Money market instruments, as I have already covered, these are call money, bill market, treasury bill, certificate of deposit and commercial paper. In case of capital market, they are shares, debentures, bonds, etc. These instruments can also be classified into two parts. Some are marketable, which can be easily purchased and sold, and some are non-marketable, which cannot be sold by the holder. And non-marketable are bank deposits, NSC, etc., etc. These cannot be sold as and when an investor wants to dispose of them. The fourth part of this Indian financial system, or fourth component, is the financial services. As I have mentioned on the board, these financial services can also be divided into two parts. One part is known as fund-based services. Fund-based services include all those types of services in which funds of banks are involved, and in this broad category we include different types of loans. Loan may be for education, loan may be for house, loan may be for vehicle, etc., etc., etc. The another part of services which is very popular these days is fee-based services. Banks are providing many services for which they are charging fee. I would recall that there are many examples of such fee-based services. Very simple, a very common example is getting DD prepared, taking a locker on hire, guarantee services, letter of credit services, etc., etc., etc. So broadly, the financial services can be classified into two. One is fund-based, another is fee-based. Lastly, the last component or last part of the Indian financial system is regulatory bodies. There are three key regulatory bodies operating in the financial system. One is Reserve Bank of India, another is IRDA, Insurance Regulatory and Development Authority, and third is SEBI, Security and Exchange Board of India. I will very briefly explain what Reserve Bank of India does, what IRDA does, and what SEBI does. Reserve Bank of India is there to protect the interest of depositor and ensuring orderly growth of banking sector in the country. IRDA has been specifically created to regulate the insurance sector. It is there to protect the interest of policyholder and ensuring orderly growth of insurance sector in the entire country. The last institution, that is SEBI, Security and Exchange Board of India, is there to regulate the capital market and also to ensure protection of investors' interest. It not only procures investors' interest but also ensures or controls capital market, which deals with shares, securities, etc. Now in very brief, I once again repeat, these are the 5 components of Indian financial system. I have tried to explain in very brief, though it requires a lot of periods, but I have tried to confine myself for about 10-15 minutes in this lecture. Thank you, and thank you.